I'm looking for feedback. Is this useful? James, writing the U.S. report is now a team approach. Dr. Toledo taught several people, what he wants to see in those reports. So that's what's happening. Tom and Tim say useful. Mary says useful. Sandy says absolutely. Okay, that's great. Yep, Andrea, you're absolutely right. Time to focus on getting our shopping list ready. You bet. All right. Thank you. Thank you, Val. All right, let's keep going for a little bit more, and then we'll be wrapping up here to allow Tom, our keynote presenter, the time he needs. Somebody said earlier, Stan, you never finish on time with these international forums, and probably that's going to be true today, but you know what? People seem to stick around. And I know we've got a great attendance again today. So the RT ticker timing signals, I really like those combos. When you start to, not just one, but when you see the second one and the third one, those are pretty big warnings. And you can see the MTI in the US with the 8-day moving average. We're still bearish, but we're getting close to where MTI is going to pull back up above that 8-day moving average. And we do have a little bit of, upward momentum here week over week, or sort of that 5-day period. The VIX, I wanted to mention, long-term resistance is up here, and we came up, we hit that sort of that climax top. A lot of analysts or technicians call it that climax top with the long shadow, and then it started to come back toward this gap. If the VIX continues to fall, that means the SPY is likely to rise. It's an inverse index. And you can see, again, that divergence. I know after the International Forum in January, people tell me they're really watching for divergences after my presentation. And here's another one. We have falling price, rising RT. I did want to just mention the UK views. For those of you that follow that have access to the UK subscription, I'm sure you read Dr. Paul's essays every Friday, and our international group doesn't always get that opportunity, but I love the way he set this out, the groundwork for the next upswing. And he talked about the market timing indicator and the buy-sell ratio showing mega oversold metrics. Short-term, and those traders who understand how to manage risk by acting unemotionally to stop-loss levels should be considering and preparing a hit list for bottom fishing. And he points out a response here. If you go to our blog, and I'm sure the US blog as well, and you go to the events, you can get the recording of Dr. Paul's great Monday webinars, and I'm sure he'll go through all of this, but he kind of broke it down when you're shopping to the fundamentals, technical position of the company you're looking at, and then the technical position of the overall market. Ed Subak, one of our presenters, the thematic ETF presenter from last week, says this is the weekend mirroring the 2009 Great Recession bottom. And Ed, thank you for mentioning that. It's useful to go back to 2009 and review the essays, particularly March 6th from Dr. Toledo. Itching to Rally is what he wrote, and that's a great essay. And by the way, just quickly here, when I go to our US program, and we've looked at the market timing, but you can see the Dow. This is what I mean by selling pressure is dissipating. See how the volume is hitting far lower highs, even on these big red days. It's, pressure is dissipating. And again, the consolidation, and we're in this channel. And the SPY, very similar. Selling pressure weakening. Russell 2000, we have this divergence with RT rising, hitting a higher low, and price hitting a lower low here. So we have this divergence. We had two divergences also giving us warning signs. So folks, I hope you're learning about this and it will help you going forward. And if ever you have a question, you can call support and say, gee, it looks like I'm seeing a divergence. It's looking like the market is getting toppy. What says VectorVest? And they can't give you specific advice, but they'll tell you what VectorVest is saying. Okay. And here with the Qs, the Nasdaq, we have again this consolidation, but we have a gap to fill right here. About 80% of gaps fill, so we could move higher. I don't think we'll get there in a week, but we might get there over the next couple of weeks. So something to keep an eye on. I just wanted to go through that quickly, and I know I'm not going through anything quickly, but oh, Jay, thank you for that. He says your outlook is calming. Now, if the media gets some sanity and only give the medical facts, we'll be better off keeping the powder dry. Thank you. And Mike, thank you for that. This is Mike Samonato. He says your divergence insight was a game changer, to say the least. And if you don't have that video of that international forum, you need to let me know and I'll get it to you. And Mike was the presenter for My Three Friends back in 2000, one of our first ones anyway. I think it was 2015 in December. That was an amazing presentation as well. Eric says, amen to that. Thank you. Thank you, Marie. Appreciate that. You give us confidence. So that's great. And then we're all getting our shopping list ready, and I've been compiling a list of, and I shared this last time as well, last month, the coronavirus watch list just from Google searches, put it together, and some of these stocks that are developing vaccines or they're supplying product that people need right now, if they're concerned about the coronavirus, they're really starting to ramp up here. A little bit quiet the last few days, which I think is actually a good thing, where things have settled down a little bit. But get your shopping list ready. These are some of the stocks you might be looking at, and they're not all sort of the biomedicals. I have Amazon in there. I have Clorox in there, a few of those. Attending a user group, if you watch those notices in the user group section of the views every Friday, look for a meeting near you. If you want to start a user group, contact Kathleen at usergroups@vectorvest.com. Any final questions, comments before I turn it over to Tom? I've covered a lot of groundwork and I've got a bit more in the watch list presentation to follow Tom. Jerry says biotech ETF. There's a few in there, Jerry, so you want to have a look at it for sure. Alberto, a list of my stocks. If I can remember when I send out the slides, either tonight or tomorrow, I'll put in the Excel spreadsheet so that you can just dump them into your watch list. So here's what you do when I give you an Excel spreadsheet with a CSV file. You just import symbols from a CSV file right here, and you can just import them. Or you can, they're not that many. I think I've got 24 now. You can type them in. Okay. Oh, Ursula, that's so great to hear. Ursula in Vancouver. We have a user group meeting in Vancouver on March 14th at 10 o'clock. So that's Saturday, March 14th. That's great. I'll be in Regina on March 14th. If you live in Saskatoon or anywhere near Regina, I hope you'll join us. That'll be on the 7th, actually, March 7th. And I'll be in Kelowna on March 14th. Yeah, Fahad says jailbreak search on the market, best search for bottom fishing for me. It's the most consistent for sure. The one-day Derby winners give you a good outlook as well. And I thought I showed it there. Maybe I didn't. But if we look at the views here on Saturday, and by the way, some great courses coming up, the Options Jump Starter. There's some preview courses or workshops there, webinars there. But if we look down here, maybe I skipped that slide. I'm not sure. but we had 3 bullish strategies on Friday. So something to keep an eye on. I use that as one of my timing indicators. I know it's not, it's not part of our timing, but Steve and Jerry teach that in the bottom fishing course, to look for the one-day Derby winners transitioning from bearish to bullish, especially when you see bottom fishing in here. All right. Gosh, I can't believe let me have a quick look back here. I'm sorry. Oh, I did show it. Okay. I just didn't go down far enough. I thought I did. All right, listen. There'll be more comments, and I'll go to the chat box now and try to answer as many questions as I can. But in the meantime, I want to bring in our keynote presenter, Tom Cauley. The covered call, your easiest and safest first options trade. I've had the pleasure and privilege of meeting Tom on a few occasions at workshops here and even in North Carolina. He's a delightful personality, very clear in his explanations, and very successful in his covered call strategy, and I think you're going to love it. So I'm going to turn it over to Tom. I've just got to find him in my list here, and then we move on. Tom, can you hear me okay?
Yes, can you hear me?
Yes, yep. A little faint, but we can definitely hear you, and I've just made you the presenter, so you're going to have to open your screen up.
Did that do it?
That did it. Just have to maximize it, and you're all set, and I'll just let you take the controls, and I'll chime in when we get to the questions and at the end. So thanks very much, Tom. I know how much time you've spent on this. We both commented earlier in the week that we missed out on a pretty big up day finalizing our presentations on Tuesday, I think it was. So anyway,
it was $1,000 day.
There you go. Thanks, Tom, and all the best.
Well, Stan, thanks so much for asking me, and hello everybody. And I just love these international forums. I love to see what's going on in the rest of the world, and one thing I really like is to see what other people are doing. I'm always curious to see what other people are doing, what works for them, what kind of searches they're using, et cetera, et cetera. I have a lot of people say that, gee, I'd like to try options. I'd like to try getting into options. And I know a little bit about options. I've taken a lot of courses from VectorVest, but I certainly don't want to steer anybody towards anything that might possibly get them into trouble. And to me, the absolute simplest, no-brainer options trade is the covered call. Whoops, wrong button. So I've really dumbed down my disclaimer for this one. Usually I have very strong warnings about don't do what Tom does, etc. But I really don't think you can get in much trouble with covered calls. So the content of this presentation should not be considered as any kind of investment advice. It's purely for educational, entertainment, and based upon the personal experience of me, who's an experienced but amateur investor. I'm going to talk a little quickly. I've got too many slides. We did remove some to try and speed things up a bit. So I probably have too many slides still and maybe too much text. So I hope I'm not stumbling over my own words. So my agenda is one of those keep it simple, stupid ones. I'm only going to talk about covered calls, only in their simplest form. I'll show some examples of very slightly more advanced trades that are for beginners level. This is towards the end. We'll see some examples of a buy right, covered calls on stocks you already own, what to do if things turn against you, and selling calls on leaps. And leaps are just long calls that go out a year or more. And full disclosure, while the options trades discussed here are very safe and most often profitable, there are others that can inflict serious damage to your portfolio if you're not carefully prepared, or if you're gambling, or if you don't know what you're doing and haven't taken any courses. Some types of options trades can be like a monkey juggling flaming chainsaws if you don't know what you're doing. And this has been me more times than I'd like to admit. So many introductions, or most introductions to options, I think, begin with, this is a put, this is a call, you can sell a put, you can buy a call at the money, in the money, out of the money. It's very confusing. In fact, you can very quickly reach the point where your head just wants to explode. And that's me and a lot of other people I know. I won't even tell you what a put is today because you don't need to know that for this. Besides those with zero options experience, I know many seasoned investors, many of my friends who are good options, or I'm sorry, good stock traders have never traded an option. They just haven't bothered because they've heard a horror story or they just don't know where to start. So do these sound familiar? I know someone who made a killing with options. Ka-ching. I know someone that nuked their portfolio with options. Yep. I heard that options are gambling. All of these are true, but extreme, and you can really trust me on these. I can't get my head around options, so relax, join the club, you're normal. I'd like to try options, but I just don't know where to start. Today, I'll talk about what I think is the absolute easiest and safest way to get started with options and earn income with covered calls. So it's not even options 101. This is for those who have never done an options trade, don't know where to start, and may even be intimidated. There's no Greeks, puts, spreads, straddles, strangles, iron condors, hard to decipher graphs, or any other fancy underlying, jargon like underlying derivative instrument or anything complicated. No fancy software, just VectorVest and a calculator at most. If I can understand covered calls, truly anybody can. This may even be of interest to experienced options traders. Nothing I show requires a margin account. Everything can be done in a registered retirement account, or as what we have in Canada, one of them is called a TFSA, a tax-free savings account. Now, I know this is a lot of text for one slide, but I wanted to get the whole quote. This is from Get Rich with Options, a book by Lee Lowell. They used to pass this out with the VectorVest Options course, and I think Dr. D really liked this from what I understand. If you own shares of a stock, minimum 100, and you're not selling call options against them, then you're throwing away free money. Well, how can that be? Well, there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Personally, I would remove the word much. Selling covered calls is such a great strategy for padding your bank account that I still can't believe that there are investors who aren't taking advantage of it. It's one of the best ways to take in extra cash flow that you never thought you could do. Having covered calls get their name from the fact that the long shares you own will cover you against any adverse effect, adverse movement by the short call that you sell. I think this graph is very important. Every option has an expiration date, and it's a depleting asset, and it depletes at an accelerating rate. So you want to sell your option, back here or back here, because that's when you get your money, and then it'll evaporate very quickly. That's why I'm a very strong advocate of selling options rather than buying them. I'll talk about selling versus buying. Many options will expire worthless. I struggled with this word many. I had a number in there, and then I did a little research, and I found that if I had a number between 30 and 90, no matter what number I put in there, somebody would dispute it. So I removed 76.5 and put the word many. Would you rather be the buyer of these options and risk watching your money trickle away each day and at an accelerating rate? Or would you rather be the one who sold and collected your money that you never have to give back while the option price continues to deteriorate? You want to be on the right side of the trade, and that's the selling side. Now, there's two ways to sell covered calls. You can do a buy right. That's the simultaneous purchase of a stock. I'll use the word stock, and the sale of a call on the same stock. You buy the stock, you write the call. That's where the name comes from. You can also sell one call option against every 100 shares of stock that you already have in your portfolio. So you get paid to be an owner and reduce risk. Oh, and a lot of this I've taken right out of VectorVest courses. So some of the objectives of covered calls are to protect stock holdings from a decline in price, to generate cash income from your current stock holdings, to reduce the cost of a long position, to enhance the total return of a long position, to set an automatic upside profit target. If the stock reaches your strike, you can sell your shares and lock in at a predetermined profit. Selling calls is a way to accelerate the stock's payout higher, and as part of the worry-free investing strategy. Now, this is, we've all seen the MTI graph, and at certain times in the MTI cycle, there might be times that are more ideal for doing certain types of options calls. You know, on the way down, you might want to buy puts, callers, bear call spreads, etc. But covered calls, you can do anytime in the cycle. And I'm going to show you a perfect example of where I did this later in the presentation. Normally, a covered call seller would go out 30 to 60 days. I think VectorVest research narrows it down to 30 to 45 days. You can do weeklies. A lot of them have monthlies, but some have weeklies. Monthlies pay a better premium, and they have better liquidity. Some traders might want to plan trades around the ex-dividend date in case the option buyer wants to exercise early and get hold of your stock and get the dividend. But I don't give much thought to this at all, because it doesn't matter if you get called away early. You still win because you got called away at maximum profit. We're in this for options premium, not dividends. It's not a dividend game. Now, this is a generic example of a buy right. Say we buy 100 shares of XYZ at $60. We sell one $45 day 62.50 strike call, and they give us $2. So now our cost, I'll ignore the commission, but our cost for the stock now is $58. At expiration in 45 days, if XYZ is above 62.50, they take our stock away, but our cost is still $58. We make $4.50 or 7.7%. If XYZ is below 62.50, we still own 100 shares of stock, and our cost is still $58. It's 3% lower than our original cost. But we can go ahead and sell more covered calls. We don't start to lose money until we're under $58. Sorry, I'm losing my voice. So we made 7.7%. Now, this is kind of a personal thing with me, but I might sell a covered call one day out. I might sell one on a Thursday that expires on Friday, or 12 days out, or 15 days out, or 2 months out. So to get my head around this, and maybe this is just me, but I always like to calculate it so that I know what percentage per month I'm making, or what percentage per year. So this is 45 days. It works out to 5.2 cents per month. Now that's not chump change. What is that, like 60% a year in 45 days? That's not bad. So, and again, this comes right out of one of the courses I took. 3 positive outcomes for writing covered calls. A good one is when the stock price declines slightly, the call option expires worthless. We keep the stock, we keep the premium received, and we sell another call. A better outcome would be the stock price slightly rises instead of drops. The call option still expires worthless. Again, we keep the stock and the premium, and we can sell the stock at a profit or sell another covered call. The best result is when the strike price rises. The best result is when the stock price rises above the strike price. The call option closes in the money. The stock is called away for maximum profit. So here's some examples. We buy TSN at $80.47. We sell the 82.50 strike for $1.23. So now our break-even cost for the stock is $79.24. TSN closes at $82.17 on expiration. So we get to keep $95 of what would have been or could have been a maximum profit of $326. Now I'm going to stick with my math because I've done it a dozen times, but I got $93. But I guess that's neither here nor there. A better outcome, this stock, ABBA. We buy 100 shares of ABBA at $72.93. We sell the 75 strike for $261. So now our break-even price is $70.32. The stock closes at $74.36, and we keep $404 of the maximum profit of $468. Now here's the best outcome. We buy 100 shares of CNC at $97.50. We sell the $100 strike for $3.18. We take in $3.18 for cash per share. Our break-even price is now $93.99. CNC closes above the strike at operation, so we keep the maximum profit at $601. So we kept the capital appreciation and the entire premium. We don't have the stock anymore, but we can go buy another one. Any questions so far? Any easy ones?
I'm just going to have a quick look through, Tom. Kamel is asking, ideally, when is it optimal to sell a covered call? And I know you had the MTI graph up there, but is there an optimal time, the best time to sell?
Some might say when the stock, when the MTI is on the way up. I made a little graph that I haven't shown yet that I think might be helpful. It might answer that question.
Okay. And Michael is wondering, if you go out a ways on a long call, you may be tying up your money. Can you close the trade early?
Yes.
That's an easy one. And James is asking, what's the worst case scenario? And I think Tom's going to get into that and how you handle that as well. Rob, as a UK resident, I know there's different types of options over in Europe, for example, so you really want to contact your broker on that. And Mark is asking, do you trade only the US options, Tom?
No, I don't. I trade Canadian ones too. In fact, I started out trading Canadian ones, and I'm going to show in a minute that there's a lot more opportunity in the States. There's a lot more stocks, as you know, and I believe the options pay better in the U.S.
And Raj says covered calls do not work in a rising market because you're better off holding on to the stock. And Tom, I know you've talked about that with me, that you never want to do a covered call on a stock that you don't want to have it called away. So
right, but I'm also going to show that I'm going to make sure that I probably will get called away, and I don't care, and I'll show you why.
Okay, and you know what? There's so many questions, Tom. I know we can't get through them all, but I think your presentation going forward is going to answer quite a few of them. And I'll just keep making a note of the ones that I think we need to make sure we answer. So I'll let you carry on from here.
Okay, terrific. Thanks very much. Can you hear me now, Stan?
Yeah, I muted you instead of me. Sorry.
That's okay.
My fault. Here we go.
Okay. I'm just going to make mention of, we can look at covered calls in different ways. And some I look at as defensive and some as income, et cetera. So I'm going to mention a defensive covered call on a high RS stock. You own a good high RS dividend stock. You get a confirmed down call and the stock starts dropping. You don't want to lose this stock. So you can sell covered calls, keep collecting your dividends, and wait for the stock to go back up as a high RS stock will. And Stan, I know you and I both know at least one person in this forum that's held on to some high dividend stocks for 20 or 30 years. And I know that guy doesn't want to lose them. And I'm guessing he's selling covered calls. This I took from the Ultimate Retirement Solution. It's a checklist for generating steady retirement income. Every Friday, you can go to InnerSearch and the Retirement Income Portfolio search or some other search. Choose return options, rate of return, set the parameters to calls, set the expiration to 30 to 60 days to find the best premium, set to 1 strike out of the money as a starting point. And I'm going to show this on the actual software or on a slide depicting the actual software. Return the search of the top 20 and find the best premium. Keep in mind the spread and the liquidity of the option. Purchase round lots of the proper stock and sell the covered call. How much premium? Many covered call writers aim for years. I used to read that covered call writers should try and get 2%. I was never clear on whether that's 2% a month or 2% for the 45 days or the 60 days. I wasn't sure what that meant. So I thought, well, I'll go for the 2% a month. Can't go wrong that way. So when I first started selling them on stocks like Apple and Microsoft, etc., that was my minimum target per month. And I thought the idea, this might address somebody's question that I just heard. I thought the idea was to try not to get called away, to keep your stock, try and get some money, but don't lose your stock. But then I was thrilled one time when I got 4% on Apple. And I called my good friend and VectorVest member, John Totten, at the time. And I said, John, I just did a buy right with Apple and I got 4%. And honestly, I can't remember if that was 45 days or a month or what. And John said, holy cow. He called me back half an hour later and he said, Tom, I bought Apple and I got 4%. We thought we were kingpins. I learned later that this can be chicken feed. I try to find what I think of as extreme covered call trades. I try and get as much as I can. This really can be an incredibly powerful strategy, which at first you might not think that it is. So here's an example of selling calls against an existing holding. It was TK Tankers. Do you remember a few months ago when that little sector or industry was just going crazy, the shipping? On October 17th, I bought 3,076 shares at $2.12. On October 23rd, I decided to sell 30, November 15th, $2.50 contracts for 15 cents. Now this stock, it's a cheap stock. I think some refer to stocks under $5 as penny stocks, but the options were in 50 cent increments. So I sold these contracts for 15 cents, which doesn't sound like a lot of money. But if called away on November 15th, I get my $2.50 strike minus my $2.12 what I paid. So 38 cents profit plus the 15 cent premium. That equals 53 cents divided by $2.12. That's 25% profit. Holy cow. And that's 25% in 23 days. That's 33% a month. That's almost 400% a year. I mean, you won't get this with your CD or your bank account. How does this compare with your 3% dividend? You know, before VectorVest, I used to buy dividend stocks when I was younger. Now that I'm old, I can't wait for 3%. I'll be dead long before, I get my 3% at the end of the year probably. November 15th, the stock hit a high of $2.45 and it closed at $2.39, which is under my $2.50 strike. So I kept my stock and I kept the $450 premium. Well, there's a little more to the TK Tanker story. TK had a reverse split, and now I have 384 shares. Now, generally, as you know, reverse splits are bad news. We see this with junior miners, et cetera. The stock was down to 20 cents and they do a 20-to-1 reverse split or something, and it's usually not a good thing. In this case, it was. December 2nd, I bought 16 shares for $19.50 so I could have a nice round 400 shares. December 5th, I sold 4 December 20th, $20 covered calls for $1.10. And that's only 15 days. Oh, boy. So that, if called away, that would be 51 cents stock profit plus $1.10 premium. That equals $1.61 divided by my cost of $19.50 times 100. That's 18.2% 0.26% profit for 15 days, or about 16.52% a month, or 200% a year. I mean, I get excited talking about this. I really do. I had little doubt, nor could I care less, if my stock was called away on December 20th, which it was, and I got the full profit. Now, this is a buy right I did by using the search that I talked about a few minutes ago. A buy right, of course, is the simultaneous purchase of a stock and the sale of calls. On October 4th, I purchased 200 shares of this stock for $109.32. I used the Vector plus Vector 1.25 options search. I didn't look at any other searches. I think I actually did this in preparation for a presentation. At the same time, I sold two November 15th, $115 covered calls for $3.20. That's the cash income that we referred to earlier. So the stock now costs $106.12. That's the reducing the cost of the long position that we referred to earlier. So if called away November 15th at $115 minus our $106 cost, that's $8.88 profit. So that works out to, I'm not going to read all these numbers now that you've seen them, but that works out to 8.37% in 41 days, 72% a year. If the stock does not reach $115, then I keep the stock and the $3.20 and I sell more covered calls. November 17th, the stock closed at $117 and it was called away. The maximum profit on the buy right was $1,776. How to get the best covered call? Use the searches retirement folder. Well, one way is to use the researches retirement folder, especially that one good search, Vector plus Vector 1.25. Look for the options rate of return, sell covered calls at or one strike out of the money. You should have an exit strategy. Let the stock get called away for maximum profit. That's one of my favorites. Buy back the call and sell another call. Get out of the stock if necessary. If it falls a lot, consider using a stop. An example might be the stock price minus the premium minus X% stop loss, and you're out. Again, I learned this in one of our courses. We can buy leaps, and again, for beginners, or I don't want to throw jargon into this. Leaps are just long calls that are very long. They're like a year. So we can buy a leap and just keep selling covered calls over and over again for shorter time periods. Here's how you do that search. I didn't want to take a chance on doing it on my actual computer in case I screwed up somehow, so I made a slide out of it. But I went to the searches retirement folder, the Vector plus Vector 1.25 search, set it for calls, set it for one strike out of the money, 43 days out, search for the top 20, set this for options rate of return, run the search, and then sort this column is options annual rate of return. Sort it with the highest number at the top. But I didn't like the look. I like to look at all the charts, and some of them weren't even going down. So instead of taking the one that just had the highest number, I looked at all the charts until I saw one that I really loved, and it was called NXPI. And I honestly don't know if I ever even heard of that stock before, but that was the one I bought, and that was the one I went with. Personally, I like the idea of getting the biggest bang for my buck in the shortest time possible, but that means greatly increasing my chance of having my stock called away, but I don't care. Therefore, I want to be sure that I'm going to be happy with whatever profit target at the strike price I've chosen, because I'm almost counting on being assigned. If you want to keep your stock and minimize the chance of getting called away, you can use a higher strike, or you can use the Greeks, which I'm not even going to talk about. You'll get a smaller premium, but you'll increase the chance of keeping your stock. Remember, I showed this graph. Here's where I'm working, mostly. I try and get in this last 30 days when the value goes down so fast, I'm more guaranteed that I'm not going to get called away, while the other poor guy that bought my stock is losing money quickly. Now, I'm not a fancy guy. I'm not good at math. I'm not good at spreadsheets. But sometimes, if I'm not in a rush, and I try not to be in a rush, I'll sit down and I'll make a little spreadsheet for myself to try and figure out which date, like how far should I go out to get the best money, because it varies. I chose a stock right out of the air. I didn't look at any other stocks. I just thought Alibaba is a very popular stock for options. It's the 9th heaviest traded stock for fund managers. So I just took that stock on February 26th. The price was $208, and I thought, okay, let's look at the $210 strike and see how much we would get. So I wrote down this has weeklies, so I recorded the dates, the numbers of days till expiration for each date, and I looked at the premiums. For 8 days out, $4.90. If you went out 27 days, they'd give you $7.94. Wow, that's a lot more money. Then I took the premium plus the profit. The profit on this minus this would be $1.26. I added those together. Once again, the farther out we go, I guess that's why they say time is money. If I converted the premium and the profit 2%, once again, I get a higher percentage the farther out I go. But now remember what I do to try and get my head around this thing so I can understand it. I converted it to percent per month. Well, lo and behold, if I go out 8 days, I get 11% a month. If I go out 27 days, I get half as much. So which one am I going to sell? I'm going to sell this one. It's a volatile stock. Who knows where it's going to be in 27 days? It could go way up. It could go way down. I'll get my more bang for the buck right here. And that's 134% a year. Here's another example, Roku. Okay, this is selling covered calls against long calls, not leaps, just long calls. On November 27th, with the stock price at 161.60, I bought 5 January 160 calls for $15.40. On December 3rd, I sold the December 6th. Now, this is just a couple of days out. I think it looks like 3. I think on the chart, they actually call that 2 days. I sold these calls for $157.50, and I took in $1.05, over $500 in just a couple of days. On December 5th, I didn't even get to the 6th. On December 5th, the stock was at 149 with 1 day to go. So I bought back the December 6th calls for 20 cents or $100. Yes, I didn't mention earlier, you can buy these things back. So I made $425 that week just in a couple of days. The same day, I sold the December 13th calls for $220, and I took in $1,100. And I thought, well, this sounds like a good deal. I spent $100, I got $1,100. So I took in an extra $1,000. I made $1,000 now for the end of next week, a week plus a day. Well, the next day, I bought back those calls for 77 cents because I found that I could make $715 overnight. So why wait another whole week to get a crummy $285? On November 9th, I sold the December 20th 160s again for $2.05 and took in $1,025. So as you can see, if you're like me and you can't keep your fingers off the computer, you can just keep rolling these things, some of these things out and making more and more money. Now, I'll do a Canadian case study. I live in Canada. Options in Canada generally do not pay as well as the ones in the States, but we shouldn't rule them out. About 50 stocks pay very well, and there are sometimes big exceptions. Now, this 50 number, I didn't research this. I learned this from someone in this international forum a couple of months ago. I can't remember who it was, but somebody spoke up and said there's about 50 stocks in Canada that pay very well. And for many years, I have sold covered calls and done other options trades on Canadian stocks, and I did notice that a lot of them don't pay well, and there's a lot of stocks that don't even have options. FM, First Quantum Minerals. For me, this was a big exception a few years ago. The options were on steroids. And I love it when I find what I can think of as extreme covered calls, and this was a prime example. I did a whole presentation on this, and if anybody wants it, I'll gladly send it to them. It's a few years old, but I just took one example out. On July 15th, 2016, the stock price at the close was $10.21. On August 19th, the $11 strike paid a premium of $1.05. So if I lost my stock at $11, I'd get $11 minus $10.21. So that's 79 cents profit plus a premium of $1.05. $1.84 divided by my cost price, that's 18.02%. On 100 contracts or 10,000 shares have called away, that's 18 grand. That's 193% a year. If the stock is not at the stock price at expiry, I still get to keep my $1.05 or 10.5 grand and also keep my stock to sell calls on it again. Now, I want to say these trades are scalable. This was a special circumstance. I'm not a rich guy. I kept selling covered calls and naked puts, and I just kept plowing the money back in and buying more and more shares. And these shares went down and down at one point, and they became very cheap. So I ended up with a lot of shares, and I was using a separate account. But if we look at this example from another angle, another way we can look at this is say that was a buy right. We buy the stock, we write the call at the same time. We just paid $10.21 for the stock, and we can subtract our $1.05 premium. So in effect, I gotta have a drink of water, I'm sorry. In effect, we just bought a $10.21 stock on sale for $9.16. That's a 10% discount. Who buys a stock at a discount? I read an article once about Warren Buffett. He was buying a company, and I thought, ooh, if Warren's buying this company, it must be a good one. Maybe I should read the rest of the article and look at the stock. Well, when I got farther down in the article, I saw that Warren was getting a 10% discount on the stock. So I thought, okay, I won't buy that one. I'm not going to get the 10% discount. Maybe this is common stuff in big business where you're buying and selling companies. But if you can do it at home on your laptop, that's awesome. So here's some of the trades. I think I played with this FM thing for about a year and a half. I think this is about a year's worth. When I started doing it, the stock was about $7 or something. And forgive me, beginners, I'm going to use the word covered or naked puts. But I was selling covered calls and naked puts all the way down from the $7 to about $2. In fact, there was a bit of gambling in here. I remember one day I had naked puts with a 250 strike, and on expiry day they expired at $2.51. Anyways, I did it on the way back up, and I did it way sideways. And if you think about that market timing graph that I showed, where it said you can sell covered calls anytime in the market cycle, I don't think I can think of a more perfect example than this one. And my dear friend Peter Hess would always say about this and things like it, it'll work until it doesn't. And it did until it didn't. And I have revisited FM several times over the years. I've traded the stock, I've traded the options. I think most times I've lost. It just doesn't pay like it used to. I remember up here at $7, the options might be 65 cents. When it was $2.50 or $2, the options were still 60 cents, 65 cents. I don't understand that. Maybe a real options trader out there can tell me how this works. Up here, they were like $1.05. Thermo Fisher, I'll call this defensive and income. December 10th, I bought 100 Thermo Fisher at $317. December 26th, the stock was up to $326. I sold one January $330 call, 22 days out for $3.30. So my cost is now $313.98. TMO closed on the expiry date at $339.19, and it was called away. But I got a maximum profit of $1,602. AMD, I read that this is one of the most successful or best performing. I don't know if it's NASDAQ or S&P stocks over the last 10 years. I guess this sucker just keeps going up and up. But on January 2nd, I bought 500 shares for $48.95. On January 6th, the stock had dropped slightly to $48.29. And I sold 5 January 17th $50 calls for $1.03 for only 11 days. I'll use my purchase price, the higher of the two, for my calculation, and I'll just treat this as if it was a buy right. So if called away at $50 minus $48.95, that equals $1.05 plus $1.03. I hate to go through all these. I don't want to bore you with all these calculations, but it works out to 11.7% a month or 140% per year. AMD closed at $50.91, and it was called away at maximum profit. And I was kind of glad. You know, this was a $50 strike. If it had been called, you know, if the stock had jumped up to $55 or $56, I'd have been crying. Apple, this one was to protect profits and collect income. November 1st, I purchased Apple at $254. On November 14th, I collected a $77 dividend, which I guess is neither here nor there. On January 9th, Apple hit an all-time high, $310.43. And then the stock price, as well as the covered call prices, were dropping. In the media, they kept saying, Apple's going to drop, Apple's going to drop. It's gone up 30% in 1 month or 2 months or this year or something. They were scaring me. And you should never, as you know, you should never listen to the talking heads. So I sold a $320 call for February 7th. That's 29 days out for $6.37. So that would have been a profit of $17.48 if called away. And that would have been 5.66% for 29 days, 5.9% a month, or 71% a year. It was not called away. The stock closed at $318 on expiry day, and I pocketed my $637, and I got to sell more calls. Okay, this example is buy rights on leaps. And as I said, for people that don't know anything at all about options, leaps are just long calls that are very long. They go out a year. Some people might say 6 months, but I think officially it's got to be about a year to be a leap. On January 15th, the 3M stock price was at $179.38. I bought 3 January 2021, that's a year out, 165 strike leaps for $22.70 or $6,800. On the same day, I sold 3 February 28th for this year, 44 days out, at the money, $180 covered calls for $5.10. If called away, as I was certain it would be, my profit after commissions would have been $1,521. That's 16.31% or 15.36% a month or 184% a year. On the 28th, they reported poor earnings. The stock dropped almost 10% to $166. So I bought back my calls for 23 cents or 69 bucks. Where's my thing? They gave me 1,500 bucks. I bought them back a few days later for 69 bucks. I made a profit of $1,455 or 21.4% in 18 days. That's over 432% a year. So the effective cost of my leaps is now $17.83. And I still, at this point, I still have a year till expiry. So I decided to wait and give the stock some more time to recover a bit so that I can consider selling more calls against the leaps. The higher the stock goes, the more I'm going to get for the leaps or the covered calls. Well, Tommy Two Fingers can't keep his fingers off the computer. On February 11th, I sold the March 20th 170s for only 66 cents. The stock was at 162.21. Imagine, I got $1,500 last time. This time I'm getting 66 cents. That's just a case of can't stay off the computer. On February 13th, I bought 3 more leaps so I could average down. They were $10.40, so I averaged down to $16.58. On February 21st, I bought back the 3 covered calls for 23 cents. Well, that was half anyways. So I could sell 6. Now that I had 6 leaps, I wanted to sell 6 March 20th leaps. March 20th covered calls for 160, the 165 strikes for $1.23. So this time I took in $7.25 after commission. So now the effective cost price of my leaps is $15.27. And I can keep doing this until January. And I'm quite sure that my leaps by then will be free. And hopefully they'll have gone up in price. Ballard Power. I'm going to call this one Options for Dummies. On January 14th, I bought 2,000 shares of Ballard Power for $13.26. In 4 days, it was up 25.3%. And Don Wellwood, if you're out there on your yacht listening to this, thank you very much. But January 23rd, the stock tanked on earnings to $11.26. So now I'm down 15% instead of up 25% from my purchase price. Oh yeah, this was a .com stock I owned in the .com era. I also owned Plug Power in the States, and I didn't do well with either one of them. It's not a high RS stock, but lately it has been absolutely on fire. So again, thank you, Don. January 24th, I sold calls by mistake. I sold the $12 strike for March 20th, but for $2.05. Now, how can somebody sell covered calls by mistake? This is what happens when you're in a rush. 30 seconds left till the market closes, and I want to sell the $14 calls. But what do? I push the $12 button. With 15 seconds to go, I notice this. It was 10 seconds to go. I'm pushing the cancel button on my brokerage. And instead of canceling, it says cancel pending. So I thought, okay, it'll probably cancel, after the close. Anyways, the next day, I look in my account. Where the heck did this $4,100 come from? Oh my God, they filled that order at 1:30 in the afternoon. It never got canceled. But then I looked at how much I took in and what my cost is now. And then I realized if I just hang on to this, I'm still going to make a profit of $1,500. So what's the takeaway here? Even stupid people can make money selling covered calls. Remember this guy? That's me. So this is how easy it can be.
Tom, I'm just going to break in a little bit and suggest, since we're getting on in time, I know you've got maybe one more example, but you've got some really important rules. And I think after this one, maybe we get to the rules, and then there's just a few questions that I know are important to people, and then we'll make sure everyone gets the slides to see. I think there was one or two more, maybe one more example, but I think we'll just have to move a little more quickly. So that's what we'll do, if that's okay by you.
Okay, terrific. I don't think we need this one.
Yeah, we could move right to your rules, which I think are so important.
Stan, can I just say that I calculated this morning? I used the VectorVest options pricing model. And for those who know options, if I used a delta of 30 so as to minimize losing the Amazon stock, right now, 15 days would pay $27,000.
Yeah,
Don't gamble.
that is
That's
the
one of the
power of
rules.
it.
I know. Okay, have rules and stick with them. Don't sell it. Don't sell a call on a stock that you really don't want to lose. Have a target price that you'll be happy with. So if it's called away, stick to it. And I try and do this, and I don't always do it. But you should have a plan for when things turn against you. An example is to have a stock price. And in a situation like this, your stop price might be the stock price minus the premium received minus 8%. And then again, I think I learned that in one of the courses. Closing comments. Options don't have to be complicated or risky. A wild stock market is perfect for covered call writers. That's a wild stock market like we have right now. When volatility is high, so are options premiums, making this income strategy more profitable. It's more expensive to buy options now, but if you're selling them, this is a great time. I don't pretend to be the best or sophisticated covered calls trader. I've tried to present this strategy in the absolute simplest terms possible. I've tried to make this as options for dummies as possible, but it really is all I need, and it's all I really use. So thank you for listening, but remember, it might all be for nothing. Thank you. I think that's the last one.
Yep, thank you so much, Tom. I'm getting great feedback on it. People are getting excited about options again. I had a comment from, I've lost it here, but Jake says kind of drifted away from covered calls, but time to start using them again. Gord just indicates great and enthusiastic presentation by Tom. I now have a better understanding of covered calls and values. And I did chat in, and let's see, I guess when I get the screen back, I'll show you a link. There's some free webinars coming up that VectorVest is doing that cover some of the basics, so that's going to help as well. And Andre says, awesome. That's great. The questions, though, in terms of your brokerage, Tom, are commissions taking a bite out of this, and which brokerages do you use that you might suggest are good?
I'm with TD. I kind of feel like my brokerage, I've got my actual trade fee down to $4.99, but TD charges more than some others, I think, per contract. I honestly can't remember if I'm paying $1.25 or $1.50 or $1.35 or something, but I believe that other people, and maybe you know more about this, I think I have friends that might be with Quest Trade or one of these other brokers that might be paying less, like 80 cents or something. I'm very jealous of these Americans that now don't pay any commissions. I guess we'll probably never get that in Canada. The commissions to me aren't too big of a deal. They were when I was trading FM, and and it was like 100 contracts, and my commission was in the hundreds.
I'll just say Fahad is mentioning TD Ameritrade with Thinkorswim is 65. I have to say I pay more than that, Fahad, but if you're more of an active trader, that would be pretty good. And I do use Quest Trade as well, and you get a little bit better break there, but I use TD Waterhouse as well. Yeah, so Tom, for most of us, Tom is right. Quest Trade options are $9.95 and then $1 per contract, so a little bit better.
I think if I just do like a regular sized options trade, like 5 or 10 contracts or something, I think I'm paying about $17. Yeah. But don't forget, if you live in the States, these are only Canadian dollars, so they're like play money for you guys. Well, but you don't pay commissions anyways.
Yeah, things have sure changed in the U.S. For that. So I think you've answered really all the questions. Billy just commented, AMD has been a great stock and currently owns a covered call, but I'm getting a lot of feedback that people have felt sort of reinvigorated about covered calls, and some are still struggling with it, but others, the Ashcan, for example, out of Calgary, says this was a great explanation, helped him tremendously. So I think that's great. I'm going to take back the screen, Tom, and just finish up now. And let me just do that.
Well, thanks very much for the opportunity, Stan, and thanks everybody for listening.
Okay. All right. Well, thank you again, Tom. That was pretty awesome, and you will get the slides. And folks, I know there is a learning curve. I know when I started doing options after VectorVest training, it takes a little bit, but there's one course that I would recommend that sort of takes options down to the basics. They don't waste a lot of time on sort of all there is to know about options, but they cover the basics, including a great section on covered calls as well. And it's the options jump starter. So there's some free sessions coming up, and I put that I put this one of the links I put in the chat box, but you can also find it in the views from Friday as well. So just take a look at that. Rick, if there's some specific questions, what I would suggest is do call support if it's a general question. If it's something specific that Tom can help you with, make sure you chat it in, and I will forward. I noticed a couple of others that had asked a question for Tom, and I will forward that on to Tom, and I'll leave it up to him to respond if he so wishes, because I know there's you can get overwhelmed if people have basic questions and so on. All right, so and by the way, Bob T said outstanding presentation and love the graphics. So that's pretty cool. All right, thanks everyone. That was pretty terrific. I just want to take a few minutes because I think people are talking about getting their shopping list ready. And so I kind of wanted to go through that. I just saw Martin's question. When I started trading options, did I have an options account with TD Waterhouse? I had to go and get an options account, but Tom's strategy you can do in the registered accounts and so on, but you do need to get your approvals. And it's been a long time since I've been through that process, but pretty much they looked at your account and said, yep, you can afford it, go ahead. I don't remember having to answer any questions. All right, so let me go ahead and just talk a little bit about watch lists, profitable ways to use VectorVest watch lists that you likely have never even thought of. Many of you have, I'm sure, but there may be some things here that will be helpful to you. Why use a watch list? We want to save time, more time to close study and track selected stocks, ETFs, industries, and sectors. We had just an outstanding presentation by one of our members in Lethbridge, and it's not the first time he's talked about this. He mentions as often as he can his own trading strategy is to have a rotating watch list of 30 stocks that he gets to know. He knows them all very well, and he knows their nuances and cycles, and that's the benefit of having a watch list, and it's such a time saver. And then when a stock falls out of favor, you'll move it out of the watch list and replace it. And you might have a watch list of your best stocks from 2 or 3 different industries is another way to do it. And most investors can do very well by investing in a few commonly traded companies that they get to know very well. Why use a watch list? You'll be prepared. Your shopping list is ready when it's time to buy. And you know what needs to be sold when the market is getting toppy or overbought. That leads your portfolio technique taught in lesson 2, for example, of the successful investing course. You'll know when RT is falling. Your worst stocks are at the bottom when you sort by RT. Other stocks in your list are performing better and moving up your watch list, might be buy candidates. And you'll know when it's time to rebalance and lock in profits. So Peter Lynch wrote one up on Wall Street and other books, and he was one of the first to suggest a watch list of a handful of stocks of companies that you absolutely know, where you shop, where you see the lineups, where you see the company succeeding. So those are companies that you can invest with knowledge and confidence by putting them in your watch list. And that leaves you more time for in-depth analysis and knowledge by focusing on a smaller number of stocks. Invest in what you know is Peter Lynch's claim to fame. So routinely analyze your stocks using the power of rank analysis. So you can put your portfolio into a watch list. Of course, you want to put it in Portfolio Manager as well. But in the watch list, it's pretty easy to sort by the different columns and see which stocks down at the bottom are giving you grief. Me and National Bank, after I made a really good profit on it, I gave way too much back, and RT was definitely one of those signals that could have got me out earlier. I sold a lot of stocks near the top. That was one I didn't. I thought they would have good earnings, and they did, but the stock did not respond due to current market conditions. So this is going to be really helpful to you. You've got the sectors, and you can put a watch list again of stocks that you know and are thinking about buying, but you can also track the stocks that you own currently. Sorting by RT, tremendous technique. And then down below, the watch list average. Mike Seminato taught us in the My Three Friends presentation how he uses this watch list average and how he wants his relative safety always to be at a high level, above 1.2 or so as an average. And so he uses that aspect of it. Now this one, we don't have a lot of undervalued stocks, even after quite a bit of downturn. These are strong growth stocks as in this particular mix, but they are overvalued, as you can see. So that might be something to pay attention to. And then you can see the dividend yield. The average of this group is 2.08 and a strong dividend safety of 77. And then the nice thing about it, when you right click on this bottom row down here, when you right click anywhere in that row, you'll get a menu that allows you to create a graph. And there's your watch list graph. You can select it from here also, and you can kind of see how this basket has been performing. In this case, I believe this was 5 years. And so it also alerts you to any warning signs. When you see price really starting to plummet, that can be a warning sign that says, oh, I better take some action on my portfolio. Eric's asking, how did I shrink this watch list? Eric, all I did was right click on one of the stocks, and in the layout, you can very quickly, and this is important for a lot of folks, just sort of one of the tools a lot of people don't know about. But for example, when you right click on Real Matters here and you go to the layout, you'll come up with another menu, and up here, up at the top, is where a lot of folks have trouble, just right up here. So what you want to do is come in, left click on it, and then I set this down to 9, whereas every day I use 11 as my font size. So that's one way you do that. Okay, just very quickly on that. Fahad, yeah, he's asking, is the fact that the basket is overvalued a negative? Well, it is, because VectorVest has proven that over time, you look at the top 10 VSD stocks at any time, 6, 7, or 8 of them will be undervalued stocks. They tend to perform better. So there's probably, here's Franco Nevada, which is strongly overvalued. Shopify in this list, there may be 1 or 2 or 3 or 4 that are just, here's Boyd Group. Listen, I personally, I own Boyd Group and have done so for many, many years, and it's just a great company that keeps making money and not paying a huge dividend, but performing well. but it has gotten to a point where it is overvalued, so you've got to watch it a bit more closely. So those are some of the main reasons why the overall basket is overvalued. So it's a concern, and that's the beauty of that watch list average. It alerts you to that. Yeah, Kamel Amara is another one. Yeah, about overvalued by half, and yet it's a strong stock and has held its buy recommendation through this turmoil as well. So once you have your stocks in a watch list, it's very easy to create a quick folio, and this can be your own stocks, the stocks that you own, or it can be a portfolio of stocks that you want to follow and track, because in Portfolio Manager, those stocks just you can't hide from them, because anytime you click on portfolios, you can get the model portfolios here. The VectorVest model portfolios, which have, they've suffered in this downturn, but the number 2 conservative, for example, is out of stocks totally right now, waiting for the buying opportunity. But you can kind of see here, and I've got a few examples. For example, I track a number of industry stocks from the energy index, and I track them so that I can see intraday here how they're performing, but I can also see how they're doing on an end of day basis from the time that I created the watch list back here. And you can set the watch list back if you like. And you can see by clicking on ROI, you can see that only CNQ since 2013 has managed to turn a profit. This does not include the dividends. This does pay a good dividend right now, especially. So you get a lot of great information by that. Here's the Consumer Discretionary Index in Canada, for example, a pretty good basket of stocks, good quality stocks, and you can track these in the same way. Had a pretty decent day on Friday, which wasn't a good day overall in Canada. These stocks held up not too bad. And the other thing, I think I've got it on another slide, now that we have the earnings dates, when you put the earnings dates on your watch list of stocks that you own or a watch list of stocks that you're intending to buy, you can't miss the earnings date. I've just moved it up earlier in my screen here, or in my viewer, but you just can't miss it. These are the 5 dividend growth stocks that I highlighted in the dividend growth report that I did for Canadian VectorVest Canada. These are stocks that have long-term been extremely strong performers. If I change this to end of day, let's see how far back. So from 2007, that's how this basket of stocks has performed. So again, if you hold good quality, high relative safety stocks, they're paying a dividend, and now thanks to Tom's presentation, you know that you can do some covered calls on these, and you can learn about other protective option trades like collars and puts, and down the road. The covered call is the starting point, as Tom nicely identified for us. But that's another way you can track copper stocks. Just different ways that you can use this technique. And by the way, when you go back to the Viewers tab, let's go back, for example. In Canada, we have a number of capped indices, for example. Here's the information technology. These are stocks that are TMX has decided are the benchmarks for technology in Canada. Once I've got the list up and running, so this is maintained by VectorVest, I can go back now in the date calendar, just open the date calendar and say I want to go back to January 2nd of 2019. These are the stocks that the TMX stat had in that list. There's some different ones in there now, but now I can go ahead and quick folio all. Tech stocks, $100,000, doesn't matter. Commissions I can set per trade. Long purchase type, you got to make sure that's checked. I can even add stop criteria if I want. And when I click OK and open the portfolio, it's now going to take me all the way back once I change I've got this default setting in applications to intraday, but let's change it to end of day. Oops, and let's change the color so you can see it. And so the tech stocks from January to now have done pretty well. And who's the leader? Shopify. Kinaxis is up there. So it kind of gives you that idea. So here's a dividend watch list, and it kind of puts the information for stocks that you're tracking sort of all together for you. And filter on watch lists in Unisearch. So for example, up here on the top left, you can have a stock watch list equals 2. In this case, I want to look at the coronavirus list, and I want to find, in this case, I use a delta. If you have intraday or real time, you'll be able to use a delta with just minutes or an hour or so, and see which stocks ended the day Friday with the biggest gain. So INMD ended Friday with a 2.92% gain in just the last 30 minutes. And you can see the others here. Clorox had a big close on Friday. Or you can do it end of day as well and see which stocks did the best the previous day. And you can use the filter on a stock watch list with any of your favorite searches. And here you can find which stocks, for example, are in all 3 watch lists. You just put stock watch list equals, and you might put in, for example, S&P 100 and NASDAQ. So the stocks have to be in one or the other of those 2, but they also have to be in the 5G watch list, and they also have to be in the WOW watch list here in the US. So you can do that kind of an approach as well, and you can also put in does not equal. One of our instructors at VectorVest has one stock that he's never had any success with, so he has a watch list with just that one stock in it, and as a default he always puts in does not equal that watch list. John, to identify these coronavirus stocks, I just kept going to Google and the news and identified the stocks that are creating vaccines, that are having some successes, that are supplying products. Like Ahmed had a couple of big days supplying one of their products. So that's all I did. And then you can kind of track them. And you know, same idea. Go back as far as you want to go back. I went to February 3rd when the coronavirus was just starting to ramp up a little bit with concerns economically, globally, and that's how this basket has been doing. These are the returns. I haven't captured all these returns. All right, so that was it. I hope that was helpful. It's a really quick primer. The 5G watch list, Bruce, is in the overview folder in the US. It's a terrific watch list of stocks on its own. So just go to the Viewers tab, and you can sort here to find it as well. Oops, I guess that's what I've done here. But also you can just go down to overview watch lists, and it's right there. Apple suppliers, another great list that VectorVest maintains for us. The pot stocks, they maintain that list for us. So there's lots of different things here. All right, I hope that was helpful, folks. Thanks, Sean. Appreciate your comment. He says, great presentation. Oh, and Audrey says you can add DRAD and OPK to your Corona watch list. Thank you, Audrey. I'll look into that. Thank you, Fergus. I really appreciate that as well. Another great webinar. People are commenting. Great load of information today. Thank you. Says, I think it was Richard. Sorry, they're coming in fast and furious, which I always appreciate. We love the feedback, even if sometimes the feedback isn't what we want to hear. And but for the most part, I see everybody kind of liked what we've done again today, so that's pretty terrific. Thank you, William. Appreciate that. And Jurgen, thank you. Oh, thank you so much. Tom says, wild applause from your friends down here in the States. We appreciate your efforts. Thank you so much. The international aspect and flavor of these webinars makes it such a treat to be a part of, and the comments and questions are just fantastic always. So the credit for these goes to all of you for sure. All right, so thank you for that, Jeffrey and Umesh and everybody. Very informative. Everyone's saying a little caution on the coronavirus stocks. Sorry it's gone so fast, but from someone. So yeah, you want to use caution. You want to make sure the stock is rising. But you know, when you look at those stocks, some of them. If you have intraday, it's a real advantage because you can. Oh gosh, I don't know where that graph went. Oh gosh. All right, let's see if I can find it down here. But if you have intraday, is that it? Oh, all right, I won't be able to find it. Let's see if that did it. No. All right. I don't know where it opened up. Got three screens going and they're all covered up. So, but you can kind of track intraday. That one can move, you know, $4 or $5 in a day, but both ways, as somebody said. Donald says, how do you get those earnings dates to show in your watch list viewer? So you can't see it in the watch list viewer. You need to move it from the watch list over to portfolios. And once you have it in portfolios, then right click on it, on any stock. Just right click on any stock, go to the layout down here below. If you can see my mouse down below there, go to the layout, and support can walk you through this. But here's the earnings dates under capital appreciation, and just click on the arrow here to move it over. And then I just move it up. So I highlight it with the left mouse, use the up arrow, and I get it to where I want up early in the settings. And Audrey says ZM had a great lift for home office conferencing with the virus scare going on. So that's awesome. Another one to look for. Yeah, Chris, this is being archived, so I keep a list in a Word document, and from time to time I send out the document. It has all the dates, the descriptions, and information. And if you're missing something, you need to let me know, and I can get you one. All right, now we really have to go. Thank you so much, everyone. It's been another great forum. Thanks again to Tom Cauley for an amazing presentation. I know he's created a lot of interest in the options. I hope you'll attend again one of those option classes in the US side, just to whet your appetite a little bit more. It's the options jump starter, and you can just register for any one of the sessions. So thanks again, everyone. Have a great rest of your day. You're welcome, everyone.